Hello.
Welcome to episode number 5. I know in the last episode I mentioned that I will be showing you guys my current stock portfolio and my investment strategy. However, I was talking to a friend and I realized that this topic would be better suited for this sequence. And so in this video, I will cover what exactly is stock market and how the heck it works. So let's figure it out. To make it simple to understand the stock market, I am taking an analogy of a regular supermarket. So shall we go for a tour? In this analogy, the supermarket represents the stock exchange. Now there are a lot of stock exchange, just like we have so many supermarkets around us. But for stock exchange, we usually have one for each country. Let's say Singapore Stock Exchange for Singapore, we have Hong Kong Stock Exchange for Hong Kong, then we have Tokyo Stock Exchange for Japan. But there are a few countries that have two stock exchange, just like US. US has the New York Stock Exchange and the Nasdaq. All these stock exchange from around the world collectively are known as the stock market. As we enter the supermarket, what we see is a whole bunch of aisles. And each of these aisles represent a different sector. So we have the technology sector, we have the utility sector, healthcare, and so on. And now as we go closer towards the aisles, you'll come across a lot of companies. These represents all the companies that are listed on that particular stock exchange, well organized into different sectors. Each of the product on the shelf over there represents a lot of shares of a particular company. To understand what I mean by a lot of shares, let's look into a product. So a product that you might want to buy may only come in 100-gram packaging. Now you can't say that you'll open up the packaging, split it into half and only buy 50 grams. That's not how it works, right? The same is applicable in stocks. So a lot of shares is just the packaging of the shares. And the size of the packaging is determined by the stock exchange the company is trading on. For example, companies trading on the Singapore Stock Exchange are only available in 100 share lots. So each time you buy, you have to buy in the multiple of hundreds. You can't buy 20 shares, you can't buy 50 shares, you can't buy 150 shares, irrespective of what is the price of individual shares. Now you may become a part owner of these businesses or companies by buying their shares. But the thing to take note of is that the prices of these shares fluctuate every second depending on the demand and supply. We will talk about it later on in this video, but what you should know is that you can see the price before you buy, just like the price tags on a product. So let's say you have decided which product to buy, and now you would have to check it out. So for that, traditionally you would need a help of a person known as the cashier. This cashier represents a broker or a brokerage firm in the stock market world. The broker's job is to take the money from you and give you the shares you want. And obviously they charge a fee for that. However, recently you should have started seeing some self-checkout counters popping up in your local supermarket. These self-checkout counters represents online trading apps. Since the companies have eliminated a human employee, they can now charge you lesser transaction fee than they traditionally would. Some apps even offer zero commissions. Unfortunately, in Singapore where I live, there's no such app and I'm still paying like a bunch of. So with that analogy, I hope you have a better understanding of what roles individual stakeholders play in the stock market, but that's just the surface. We also got to understand what are shares and how the heck they get on the shelves of the stock market. For this, let's assume that we started a new business, a restaurant maybe. So in the start, we will own the entire business. We would still have the number of shares, and it doesn't matter what the number is. It can be any random number, 1,000, a million, or 999, whatever number you want to give. What really matters is the percentage. And at this time, we have 100% of the shares. This used to be the case traditionally, where one single dude, and it was almost always a dude, owned the entire company and used to have a very tight control over it. People such as Andrew Carnegie, Vanderbilt, and Rockefeller. But then the things changed, and to understand why, let's go back to our business. Now our restaurant is profitable and let's say we are making 100K a month. That's not a lot, But if only we had 10 outlets, we would be already churning out $1 million in profit every year. However, to open up another outlet, we will need 200k in investments, and that we don't have. So we could wait for our restaurant to make 100k every year, and every second year we could invest that in opening up another outlet. But that is gonna take super long. If only we had more cash in hand, we could have opened a second outlet, and that will get us to the third outlet within a year. How can we get access to this cash? Well, we could take a bank loan, but a loan is a liability and there are a lot of strings attached to it. This is where the shares come into play and become an option to us. We can raise this money by selling a few of our shares. This is exactly what happens at Shark Tank, and let's say Mr. Wonderful is willing to invest in us 200k in return of 20% of our business, 20% of the shares. We can use this money to open up another outlet and grow twice as fast. Now as the company grows bigger and we want to raise billions of dollars, no single investor will give us that kind of money. So instead of asking single individuals, why not we go consider getting an investment from a pool of people, the public per se. To do this, we would have to put the shares that we want to sell on public offering. For this, we would have to approach a stock exchange and fill up some paperwork so that we can sell our shares on their exchange. Just like how a supplier would approach the supermarket to let them sell their products on their shelves. Now, once we have sold all the shares that we wanted to, individuals in the public would own them. And these individuals can choose to sell or buy more shares at any time they want, as long as the supermarket, aka the stock market, is open. They can choose to sell their shares at any price as long as there's a buyer willing to pay that price. The opposite is true as well. A buyer can buy at any price as long as there's a seller willing to sell him at that price. This is simply a demand and supply thingy, and in the short term, it's completely dependent on the sentiments of the public. If the public's sentiment on the future of the company are good, then generally there would be more buyers than sellers. Hence, more demand than supply. And if you know basics of economics, this will lead to increase in the share price. So that's about it for today's episode. I hope I was able to explain to you guys how the stock market actually works. In the next episode, I will share with you guys the two types of investors and the investment strategy they should go for. Like always, if you're interested, just subscribe, stay tuned, and until the next video, ciao.